Imagine you have saved $30,000 for a new car. You walk into the dealership, and the salesperson asks how you plan to pay. The conventional wisdom, the advice your father gave you, the voice in your head that says debt is dangerous, all tell you to write a check and own the car outright. No monthly payments. No interest. No lender breathing down your neck. That feels responsible. That feels adult. That feels like financial freedom. But what if writing the check is actually one of the most expensive financial mistakes you can make, not because cars are bad investments, they are, but because of something much more subtle: opportunity cost, liquidity preference, and the strange mathematics of cheap debt in an inflationary world. The person who pays cash for a $30,000 car and the person who finances that same car at a low interest rate while investing the cash will have vastly different net worths 10 years later. Not because one is smarter or luckier, but because money has a time value that most people never learn to see. To understand why paying cash for a car is often financially suboptimal, we have to first confront a fundamental assumption that most people never question: the belief that avoiding debt is always good. This belief is not irrational. It comes from real experiences with credit card debt at 20% interest, with payday loans that trap the desperate, with the stress of owing money to people who can take your things. But debt is not a single thing. Debt is a tool, and like any tool, its value depends entirely on the terms. Borrowing at 20% interest to buy a depreciating asset is financial suicide. Borrowing at 3% interest to buy the same asset while your cash earns 7% in a diversified portfolio is mathematical arbitrage, a risk-free or low-risk profit that requires no special skill, only the willingness to hold debt instead of fearing it. The car loan is a uniquely favorable form of debt for people with good credit. Automakers and their financing arms routinely offer interest rates below the rate of inflation, sometimes as low as 0% for qualified buyers on certain models. When the nominal interest rate on a loan is lower than the inflation rate, the lender is effectively paying you to borrow money. You repay the loan with dollars that are worth less than the dollars you borrowed. Every payment you make is cheaper in real terms than the payment before. If you pay cash, you lose that benefit entirely. You hand over $30,000 of today's valuable dollars to avoid borrowing tomorrow's less valuable dollars. That is not frugality. That is a misunderstanding of how inflation transfers wealth from lenders to borrowers. Consider the following scenario, which is not hypothetical but is available to millions of American car buyers today. You find a car you want for $30,000. The dealer offers you a 60-month loan at 3.9% interest. You have the cash to pay outright. What should you do? If you pay cash, you have a car worth $30,000 that will be worth roughly $15,000 after 5 years, assuming average depreciation of about 15% per year for the first few years. Your net worth after 5 years, ignoring other assets, is a car worth $15,000. You also have zero car payments, which feels good, but you no longer have the $30,000 you started with. You converted cash into a depreciating asset. If instead you finance the car with zero down payment, your monthly payment on a $30,000 loan at 3.9% for 60 months is approximately $550. Over 5 years, you pay about $33,000 total, including $3,000 in interest. That sounds worse. You are paying $3,000 extra dollars. But you still have the $30,000 you started with, because you did not hand it over to the dealer. You invested that $30,000 in a diversified portfolio of low-cost index funds. Historically, a balanced portfolio of 60% stocks and 40% bonds has returned approximately 7 to 8% annually over most long-term periods. At a conservative 7% return, your $30,000 grows to approximately $42,000 after 5 years. Now compare the two scenarios. The cash buyer has a car worth $15,000 and no other asset from this transaction. The financed buyer has a car worth $15,000, but they also have an investment account worth $42,000, against which they have a loan balance of approximately $26,000 after 5 years of payments, assuming they did not pay it off early. Their net position is the car worth $15,000, plus investment account of $42,000, minus loan balance of $26,000, which equals $31,000 in net assets from the transaction, plus the car. That is $16,000 more than the cash buyer's net position. The financed buyer paid $3,000 in interest and gained $12,000 in investment returns, for a net gain of $9,000, plus the car. The cash buyer paid nothing in interest and gained nothing in returns, for a net gain of $0, plus a depreciated car. This is the core mathematical insight. Low-interest debt allows you to keep your capital working for you instead of handing it over to a car dealer who will immediately deposit it in their own interest-bearing account. The car dealer is not paying cash for their inventory. They are using floor plan financing, borrowing money at low rates to hold cars until they sell them. They understand the logic perfectly. They would never pay cash for their inventory because that would tie up capital that could be used to buy more cars, expand the lot, or earn returns elsewhere. The individual consumer, however, has been taught that debt is dangerous and cash is safe, so they voluntarily tie up their own capital in the single worst asset class they can buy, a rapidly depreciating machine. The dealer finances. The customer pays cash. The dealer gets richer. The customer gets poorer. That is not a conspiracy. That is just two different relationships to the time value of money. The argument against paying cash for a car is not an argument for buying a more expensive car than you need. The worst financial decision you can make with a car is buying too much car, regardless of how you pay for it. A $40,000 car financed at low rates is still a $40,000 car that will be worth $20,000 in 5 years. The argument is that for a given car, for a given price you have already decided to pay, financing at a low interest rate is mathematically superior to paying cash, provided you actually invest the cash you would have spent. This last condition is crucial. The behavioral failure that destroys this strategy is not the math, it is the human tendency to spend the cash instead of investing it. If you finance the car and then spend the $30,000 on vacations, restaurants, and electronics, you are worse off than if you had paid cash. The strategy only works if you have the discipline to immediately invest the money and leave it invested for the full term of the loan. This brings us to the second major reason not to pay cash for your next car: liquidity. Cash is not just a tool for earning returns. Cash is also insurance against uncertainty. When you pay $30,000 in cash for a car, you convert a highly liquid asset into a highly illiquid asset. You cannot pay your rent with your car. You cannot cover a medical emergency by selling a door panel. You cannot take advantage of an unexpected investment opportunity by borrowing against your car at reasonable rates. The car is trapped value. The $30,000 in your bank account, by contrast, can be deployed anywhere in the world within 24 hours. That optionality has value, even if you never use it. Financial planners call this the liquidity premium, the willingness to accept lower returns on cash in exchange for the ability to access it instantly. Paying cash for a car sacrifices that liquidity premium entirely, and you receive nothing in return except the avoidance of a low-interest loan. Consider what happens if you lose your job 6 months after buying the cash buyer has a paid-off car and whatever remains of their savings after the $30,000 purchase. The financed buyer has the same car, a loan payment of $550 per month, and an investment account worth roughly $31,000 if the market has performed normally. Which person is in better shape? The financed buyer can sell some of their investments to make the loan payments for many months. They can also sell the car if necessary, paying off the loan and pocketing any remaining equity. The cash buyer who needs money has only one option: sell the car. Selling a car under duress almost always means accepting a low offer from a dealer or a quick sale to a private buyer at a discount. The financed buyer has options. The cash buyer has a car. Liquidity is freedom. Illiquidity is a trap. The third reason to avoid paying cash is the psychological asymmetry of loss aversion. Behavioral economists have shown that humans feel the pain of a loss about twice as strongly as they feel the pleasure of an equivalent gain. When you pay $30,000 in cash for a car, you experience that loss immediately and fully. You watch the money leave your account. You feel poorer. That feeling is real, and it influences your subsequent financial decisions, often making you more risk-averse, more conservative, and less willing to invest in opportunities that could grow your wealth. When you finance the same car, you experience the loss in small monthly increments. $550 a month feels much smaller than $30,000 all at once, even though the total is similar. You preserve your sense of wealth, your risk tolerance, and your willingness to invest. The cash buyer has a smaller mental account. The financed buyer has the same mental account but with a payment. That difference in framing affects real decisions for years afterward. Now, the counterarguments. The most serious objection to financing a car is that many people do not qualify for low interest rates. Subprime borrowers, people with damaged credit or thin credit files, are offered rates of 10, 15, or even 20% on car loans. At those rates, the math flips completely. A 15% car loan costs $15,000 in interest over 5 years on a $30,000 loan. The same $30,000 invested at 7% returns grows to only $42,000, a gain of $12,000. You lose $3,000 in the comparison before even considering taxes. For borrowers with poor credit, paying cash is almost always the right answer, if they have the cash. Better yet, they should buy a much cheaper car with cash and avoid the high-interest debt trap entirely. The advice to finance only applies to borrowers who can secure rates below approximately 5 to 6%, ideally below the expected return on a conservative investment portfolio. The second objection is that investment returns are not guaranteed. The stock market could crash the day after you invest your $30,000. You could end up with a car loan and a portfolio worth $15,000. This is a real risk, and anyone who pretends otherwise is selling something. However, the relevant comparison is not between a guaranteed loss, depreciation, and a risky gain, investment returns. The relevant comparison is between two risky scenarios. The cash buyer also faces risk. If you pay cash for a car and then the stock market has a historic rally, you missed out on those gains permanently. You cannot go back in time and invest that money. The financed buyer who experiences a market crash can hold the investments and wait for recovery, because the loan payments are fixed and predictable. The cash buyer who experiences a market rally has no way to participate. The financed buyer has a call option on future market returns. The cash buyer has no option at all. The third objection is behavioral. Many people who finance a car use the cash they would have paid to buy a more expensive car instead of investing it. They walk into the dealership thinking they will finance $30,000 and invest the cash, but they walk out having financed $40,000 for a nicer car and invested nothing. This is the most common failure mode of the finance and invest strategy. The discipline required to separate the car decision from the investment decision is substantial. You must decide on the car you want and can afford regardless of how you pay. Then you must decide whether to pay cash or finance. Then you must actually invest the cash you did not spend. Most people combine these decisions. They say to themselves, I can afford a higher monthly payment, so I can afford a more expensive car. That logic is exactly wrong. The monthly payment should never determine the car you buy. The total price should. Financing a $30,000 car and investing $30,000 is smart. Financing a $40,000 car because you have $30,000 in cash is not smart. It is just spending more. There is also a tax dimension worth understanding. In most jurisdictions, investment returns are taxable, while the interest on a car loan is not deductible for most individual taxpayers. However, the effect is small for most people. Long-term capital gains tax rates are 0, 15, or 20% depending on income. Even at the 20% rate, a 7% return becomes 5.6% after taxes, which still exceeds a 3.9% car loan. The after-tax spread is still positive. For high-income earners in the top tax bracket, the math becomes tighter but still favors financing in most low-rate scenarios. For investors using tax-advantaged accounts like Roth IRAs or 401ks, where growth is tax-free, the advantage of financing is even larger. The historical perspective here is illuminating. In the 1970s and early 1980s, when inflation was high and interest rates were even higher, paying cash for a car made perfect sense. Car loans at 12 to 18% were common. Inflation at 10% meant you were borrowing at a real rate of 2 to 8%, not terrible, but investment returns were also volatile and unpredictable. The risk-free return on treasury bills was high, so keeping cash in a savings account earning 12% while paying 12% on a car loan was a wash. There was no arbitrage opportunity. Today, the environment is different. Real interest rates, inflation-adjusted rates, have been low for nearly 2 decades. Car loan rates below 4% are common for qualified buyers. Inflation has averaged 2 to 3%. The real cost of borrowing is 1 to 2%. The real return on a diversified stock portfolio has historically been 6 to 7%. The spread is 4 to 5 percentage points. That spread is free money for anyone with the discipline to capture it. But the car loan is not the only way to access cheap debt for a vehicle. Home equity lines of credit, or HELOCs, often offer even lower interest rates than car loans, though they put your home at risk if you default. A HELOC at 6% is less attractive than a car loan at 3.9%, but a HELOC at 3% is more attractive. The best source of cheap debt for a car is often the manufacturer's financing arm, especially during promotional events. 0% financing offers are real, though they typically require excellent credit and may replace a cash rebate. You must compare the 0% offer to the cash rebate offer to see which is better. Sometimes taking the rebate and paying cash is mathematically superior to 0% financing without the rebate. Sometimes the 0% offer is better. The only way to know is to run the numbers for your specific deal. The most sophisticated version of this strategy involves not just financing the car but also extending the loan term as long as possible, provided the interest rate remains low. A 72-month or 84-month loan at the same low rate is even better than a 60-month loan, because inflation has more time to erode the real value of your payments, and your invested cash has more time to compound. The conventional advice to pay off car loans early is mathematically backwards for low-rate loans. Every extra dollar you put toward a 3.9% car loan is a dollar you are not investing at 7%. You are choosing to earn 3.9%. Actually, you are saving 3.9% in interest instead of earning 7%. That is a negative spread of 3.1%. Paying off cheap debt early is the same as investing in a negative return asset. It feels responsible. It is financially destructive. This does not mean you should take out a car loan to invest in speculative assets. The strategy assumes a diversified, low-cost, historically reasonable expected return portfolio, not cryptocurrency, not individual stocks, not options trading. The strategy also assumes you have the emergency fund and insurance coverage to handle the risk of a market downturn. If you would not invest your cash in the market without the car loan, you should not invest it with the car loan. The loan does not change your risk tolerance. It only changes the cost of capital. The fundamental question is whether you believe that over the life of the loan, a diversified portfolio will return more after taxes than the interest rate on the loan. If the answer is yes, financing is mathematically superior. If the answer is no, paying cash is superior. The historical evidence strongly suggests that for low-rate loans, the answer is yes. The calm closing thought is this: paying cash for a car feels safe because it eliminates a monthly payment and avoids debt. But financial safety is not the same as financial wisdom. Safety is about minimizing worst-case outcomes. Wisdom is about maximizing probable outcomes over time. Paying cash for a car minimizes the worst case, you will never lose the car to repossession, but it also minimizes the best case, you will never earn investment returns on that capital. Financing at a low rate and investing the cash accepts a small amount of risk, the risk that the market underperforms the loan rate, in exchange for a large amount of potential upside. That trade-off is rational for most people with good credit, stable income, and a long-time horizon. The fear of debt is expensive. The willingness to use debt as a tool is valuable. Your next car is an opportunity to practice that distinction, not to prove that you are responsible, but to prove that you understand how money works.